Welcome to the On the Tape podcast. I'm your host, Danny Moses. Today, I welcome a fellow podcaster, the host of Monetary Matters podcast, Jack Farley. Welcome to On the Tape.
Great to be here. Thanks for having me, Danny.
So, Jack, we'll get into what a prolific podcaster you are and all the multiple properties you've created, but I want to start with this. I'm guessing, I'm not a detective, but your Twitter X handle is Jack Farley 96. I'm going to guess that you were born in 1996. Would that be correct?
You got me, and I think I regret that because I wish, on the podcast, I want to seem so much older. Sometimes
you are. I wouldn't get to that.
70, 80-year-old people.
There's an important question I'm going to ask as a result of that, which I think is crucial because I think it actually adds to your credibility, and I think it's something that I think has built you. So I'm going to get to that in a second. So if you were born in 96, you grew up during the GFC. You were a teenager, right? So you had to experience this thing. I'm guessing it shaped you in a certain way. So my question is, were your parents or family impacted directly during the GFC in some form or way?
Yes, I think you could say that. My dad's in the investment business, so I did see that emotional toll, but I think, you were living it, you were seeing the emotional toll, but also you were in it. I feel like I was a kid, so everything I learned about it pretty much, I read about it, many years later.
But did it drive you? Do you think it was like instilled in you that you wanted to learn, like what the hell just happened? Like part of you said, someday I'm going to figure this out because you were like living in real time. I mean, 13, 14 years old, during the time period. And then, you're in high school watching this stuff still unfold. I'm just curious, did that pique your interest in financials and kind of the markets?
I didn't get the finance bug until college, but I got it pretty hard, I'd say. So I'd say I got it then, but that was probably like 2016.
Okay, so at Brown, you got the finance bug. You majored in economics there, right?
Mm-hmm.
So what did you do like in the summers to kind of nurture that finance aspirations?
So I studied econ. There's no finance at Brown.
Right.
Undergraduate econ, as people watching this could know, it's different than financial markets. So when you interview an economist, it's different than interviewing an investor. Like they have the models, and then the reality is just a sideshow. Whereas in finance, it's there. You focus on the reality. I mean, it's on screens and it's still prices, right. So it's not reality, but it's the prices. And then if the models can help you with the prices, that's cool. But economists and investors look at it differently. And economics, I think I was, it's quite quantitative and model driven. I was interested in reading books by Roger Lowenstein.
Yes. When Genius Failed. Did you read that book?
I did. Great
book. That is my favorite financial book.
Yeah.
Even including The Big Short.
Yep.
Because, that book is hubris, right? It's the whole thing. It can repeat itself. But yeah, please go on.
Yeah, and I'm sure you've met people in that world, in the convertible world, and they're like, the trades were so good.
Right.
The trades were so good.
Yeah.
How did they do it? It's just they were
what it is?
leveraged. What?
Exactly right. It's leverage. See, 96 means nothing on your Twitter handle because I would say you're wise beyond your years. So
thank you.
You're building the Monetary Matters Network now, we can call it, right? So you're going to become the ringer, I guess, of the financial world. So it includes the Monetary Matters podcast, which you launched in September 2024. When you were at Blockworks, you launched the Forward Guidance podcast. And I find it really interesting that, and you pointed this out, so I'm not just guessing here, that you launched when the Fed was first raising rates of Forward Guidance, and then you relaunched or Monetary Matters when the Fed was actually starting to cut rates. So you appears to be, as I go back to your childhood, a student of the Fed. Like the Fed is the be-all, end-all. Joseph Wang was your first guest that you had, I think, on your relaunch of Monetary Matters, if I'm not mistaken, or one of the first that came on. Brilliant guy, trader at the Fed. Talk about, not your obsession with the Fed, but talk about why you think it's so important and the be-all, end-all, and can we get to a place in the markets where the Fed's just a sideshow and not the driver of the market?
I mean, they control the overnight price of money, so it's pretty important. I think even in a society where the Federal Reserve is not in control at all, even a fiscal dominant where it's the government or the private sector that's control, I think the central bank is always going to be important. And different schools, but I'm of the school that's a good thing. I think the Federal Reserve, not controlling markets, but being a backstop to markets and basically pulling the punch bowl when everyone's drunk, and also when there's a financial crisis, providing stimulus. I think that's a good thing. You could say the Federal Reserve sometimes takes things too far. I mean, you don't want to live in a world of like Japan, I guess the 1980s, when the central bank is like calling every commercial bank and being like, lend every single person you've got, lend them as much money as you possibly can. So I am a believer in private markets, but I think the Federal Reserve is a force for good.
All right. Well, I'm going to go at you a little bit on that.
Yeah, hit me.
And only because until 2008, they certainly had to set policy and really did nothing else. I mean, when the global financial system literally collapsed. They came through. And I'll be honest that during that time period, I didn't like TARP and TALF. And so between Treasury and Fed, there was many programs and PPIP and this, that, and all the acronyms, which they've literally run out of, because I'm a big believer, I think like you are, in free market capitalism. Prices should find their level where they should be. Forget about bailing out banks. That's a whole nother issue, because we all know at the time, the government and even us didn't know how bad it really was, how much leverage was in the system. So when you say they think the Fed does good, I want to be clear that I believe Powell has done a decent job, but you only know the markets. And I'm not faulting you for this. You only know the markets that the Fed has your back, and the moral hazard that has been created for a generation, which is your generation of traders that have come through. You've just answered my question for me, that you got to have the Fed, that the Fed is the put in the market. The Fed is the put. So talk more about that, because I got news for you. Before that, in the time period, that wasn't what the Fed's role was. That's not, building a balance sheet to go to $9 trillion is not the role, or hadn't been the role previously. So I'm not saying that they ended up doing the wrong thing by saving. But I have a problem with it.
I think what you said about me is also true. I think it's also true about you. I mean, I'm assuming you're not, compliment you, you're not 75 years old and was like, 30 years old when Volcker was doing his thing. Like, that Greenspan lowered to 1.75 or 1.5% in 2003. 1997 bailout. I mean, the 90s were a pretty benign time, but I think you haven't seen that hardcore, like the Federal Reserve is going to destroy the economy,
right?
Since 80, 81, right?
Yeah, but I didn't live through that necessarily, but there's no, I lived through irrational exuberance and the system is sound with Bernanke, like all that stuff. And that's just sideshow until they actually take action. What I'm saying is, listen, people can hate Volcker or love Volcker, right? There was massive inflation. He cut it off. Right? There wasn't as much debt in the system back then. We didn't have the issues we have with debt to GDP. We don't have so now we're playing a game, right? Now it's a game, right? So QE1, QE2, QE3, QE4, whether we have something called QE5 or not, I'm not sure. I wouldn't be shocked if we have it right now. And you can talk about this and you'll get your opinion on what the Fed has been doing by continuously unwinding mortgage-backed securities and let them run off. And now basically saying they're going to reinvest proceeds of the runoff in mortgage-backed securities potentially into treasuries, right?
Yes.
So they're still playing games here. That's not free market. That is not the level set. So how do you reconcile that with kind of being a capitalist?
So quantitative easing, I think the technical definition is the central bank buying securities.
Printing money out of thin air.
Yes. With the goal of lowering long-term interest rates. So, for example, back in the day, the glory days of before the Federal Reserve controlled interest rates by just setting the interest rates, they did it with the quantity of money. With quantitative easing, there's so much money in the system, they have to set the rate. And so, but by buying reserves or selling reserves in order to control the reserve pre 2008, they that wasn't quantitative easing. That was just to do their monetary goals. Quantitative easing is like, let's actually lower the yield. So yeah, the Federal Reserve, I don't know the official document, but it is an official document. They've got a chart showing they want to target their balance sheet relative to GDP. So as the economy grows, if they don't buy more securities, then the security holdings as a percentage of GDP is going to go down. So I actually think here's what I'll.
But that's they created this trap. They made that problem themselves. That didn't exist before they had all these securities and mortgages on the balance sheet, though.
But you are happy that they've been going down, right?
Listen, you're still 6.7 trillion. Am I happy it's going down? Yes, but you and I both know what's going to happen. If the rates start to go higher on the 10-year yields, their hand will be forced again. We can't get out of this, is all I'm saying. It's going to last. I guess what I'm saying is the best case scenario is it unwinds over a much longer period of time than was ever intended. And yes, bank reserves are in the equation, to your point. It's just how the banking system works. We've locked ourselves in now to kind of this twisted nature, right? It's like literally we're pretzeled in this thing, and we're going to have to deal with it. So what you do a great job is you talk about it, because that's the game we have. That's what we have to deal with. So I don't blame you. I'm not arguing with you. I'm just saying, I just want you to remember there was a period of time where the Fed never had a role like this. And I can tell you, going back to 2008, we knew there was problems in the system. We didn't know how deep it was. We didn't know the AIG. We knew Lehman was in trouble. We knew there was leverage everywhere, right? We knew that was happening. But at the same time, the government didn't know it. And certainly the banks should have known. I don't even think they knew the extent that they had. So we're still dealing with it 17 years later, because you're still talking about the issues of having to kind of dance around this stuff. So you've had a lot of guests which have come on, Joseph being one of them, obviously, but a lot of Fed-centric. You and I have shared friends, and Luke Groman and James Aiken we've had on both. So these are brilliant people who understand financial plumbing. So talk to me about kind of the monetary matters mission, so to speak? Because I think you and I share that passion for the markets and what you're really trying to convey out there.
Well, it's a pun. Number one, it matters as a noun of matters relating to monetary stuff, and then money matters, monetary matters. The verb. I think that this stuff really does impact people's life, like the level of interest rates that you can get a mortgage. The quantity and the price of money does impact stuff. But also, I'm not just focused on the Federal Reserve. Focused on the commercial banking system, something you know well, like the investment world, the level of stocks, the level of the dollar. If tariffs if you have that, basically tariffs is basically just like weakening the dollar. That's going to make imports much more expensive, but it also can promote domestic manufacturing. So I'm just saying, the economy like impacts people's lives in a real way. And I'd also say, like in kind of popular financial stuff, it's like everyone just like creates a bunch of content about stuff that they think like, oh, Joe Six-Pack on the street is into, like the price of eggs. Like that's not really my thing. I'm more about like the monetary system and monetary stuff, like not really the price of eggs.
But for the people, and I was on your podcast, and thanks
Yes.
for having me on a couple weeks ago. But I think like you aren't just trying to get an audience that invests in markets. You also would love to get people that want to know what the hell is going on. Because I've always been a big believer that there's a lot of things which can be dual roles here, right? So where mortgage rates go, tell me how to trade the banks on that and life insurance companies, but tell me how my house is going to be impacted or my mortgage rate is going to be impacted. You get rid of the CFPB, right? Consumer Financial Protection Bureau. Yay, get rid of too much regulation. Well, guess what? You may not be an investor in credit card companies and payday lenders, but you may have a credit card outstanding and your late fees are about to go up. So I like to, and I think you do too, kind of explain those things to people. They know what's going on, because unfortunately, a lot of people haven't benefited from the market run up, but they've gotten penalized from low rates because they didn't earn anything on if they had any savings, and now they're going to get penalized on high rates. So do you try to fill kind of a dual role like I try to do in terms of to explain those things as well, not just market related, but bring it down to the listeners which don't have investments?
I do it to both, but I think that there are a lot of people who aren't professional investors who are interested in, I'd say, the hardcore topics. So I do both.
Okay. So of the guests that you've had on, and I know you don't go searching for people that agree or don't agree with you, and we're going to get into your opinions in a bit here. Who have you been kind of most impressed with, or who do you think has kind of shed light or you've learned the most from as they come on and kind of?
Let's see. Well, I want to shout out this guy, Prometheus Macro.
I just saw that you were.
Yeah, Ahan. He was early to sniffing something out, which is that I was wrong about tariffs. I think that tariffs would cause a depression if we had like the amount of trade as a percentage of GDP as like Hong Kong or Luxembourg, or like a huge percentage. But I was just looking at today, so that's why I know the numbers. I guess our imports are like 16% of GDP and our exports are 11% of GDP. So like overall, trade is 27% of our economy. In Hong Kong, it's like over 100%.
Well, it's goods part versus services part.
Yes,
to your point about the economy.
Yes, but tariffs don't affect services yet. And there are a few whisper stories about tariffs.
Hold on. What do you think you were wrong about tariffs? Because you're looking at it in a 6-week time period.
Yeah. So it's too early to see if I'm wrong, but yeah. So far the market's been telling me.
I'm guessing your assumption was it's going to have a negative impact on the economy.
A very negative impact.
Yeah. Well, if they had kept them at the levels we had started with,
yes,
which was asinine.
Yes.
And I talked about that with you on your podcast. It wasn't possible to keep them there. I said that. I'm like,
yeah.
But the damage that is going to be done, and/or us as a trustworthy partner. So I don't think you're wrong. I think now if you're trying to calculate, the market should get crushed because it should portend of what's going to happen. I understand. I personally think the market's overshot its way back up here a little bit. And so I don't know where you think you got wrong. I understand the math, but go ahead.
You're right. It's too early to see if I've been wrong about tariffs going to cause a very negative impact. Here's where I know I have been wrong. I thought President Trump was way more pro-tariff. I basically took him at his own. I heard what he said. I listened to pretty much every press conference and read every executive order and every U.S. trade representative like memo. And I really did believe the narrative. Like, wow, yeah, he's.
Have you not seen his pattern in the past of that stuff? But
I'm Charlie Brown, and he put the football. I kicked. I missed.
Right. So I wouldn't be that hard on yourself, because you should believe when a president speaks that that's not going to be a bluff of any kind. But he has a history of trying to bring people to the table to negotiate. But I haven't heard Peter Navarro's name in quite some time. Have you seen him anywhere in the press? Do we even know where he is at this point? Because maybe I've missed it. You do a lot more digging on this stuff than I do.
I haven't. There was, from April 2nd to May 2nd, I pretty much every day was like a professional tariff watcher.
Yeah.
It took its toll a little bit, so I've been taking a little bit of a break on that. But no, I haven't seen it.
But doesn't that scare you that this was the person that was advising the president, that was based on nothing, and that wrote a research report that was based on himself, that he gave himself a new name? I mean, that's how we're running policy. That should scare my generation, but it should scare the hell out of your generation, because this is stuff that's going to be going on, for several years. It could have lasting impacts and stuff. So.
Yeah, I mean, it's like if you wrote a book and you quoted like Danny Seesom.
Right.
Danny Seesom wrote this great thing.
Right, exactly. That's just horrifying to me. So you've been right about a lot of stuff too. So don't be hard on yourself on the tariffs. And this guy that you interviewed, Prometheus or whatever, is him. I saw the setup. He's in looks like he's in a rocket ship.
Yeah.
Okay, is that the guy you're talking about?
Yeah.
What does he do? Podcasts all the time? He looks like a
he's a hardcore quant. His clients are some giant hedge funds, and he's very, very quantitative. Also, so like one thing that he talked about, you heard term premium.
Of course.
Yeah. So for our audience at home, term premium is basically I've heard this definition and I've recited this definition a million times, but how you actually calculate it, we'll get to. But it's the compensation that as a bond investor you get for holding long-term duration. So, the
inherent risk on
yes.
U.S. Treasury's credit worthiness in the time period that it takes to pay it back. But go ahead.
The duration,
here's a new calculation.
Everyone talks about the term premium is widening. There's a huge amount of risk and they talk about it as if it's kind of real. But he like dived into the calculation and he found that 90% of the way that term premium is calculated has literally to do just with the shape of the yield curve and the overnight rate. So it's like it's all
the neutral rate, I think.
No, the overnight rate.
Okay.
Yeah, the overnight rate. So it's all in the curve already. So you can trade the curve. Just talk about the curve. Why are you talking about something that you can't trade and doesn't really exist?
Well, the supply and demand based on how people believe the inherent risk of the U.S. to not pay on its debt is the term. In my opinion, it's the risk associated with the risk-free rate of return, to your point, maybe on the curve or what it might be, to what you're going to have to pay me an extra 10, 20, 30 basis points for me to go out in that duration. So, I mean, it is real. There is a, quote, term premium to what the fair market value probably should be. But if he's saying that...
He's saying, for example, in like inverted yield curve, so 2006, 2019, 2022, that
people out there, that's the 2-year yields being higher than the 10-year yields.
That would show that because there's an inverted curve, that the term premium is extremely negative. Or in other words, is that a time when people have a lot of faith in the U.S. credit? 2019? No, it's just an inverted curve.
The Fed was jacking up rates, and the short-term yields go up, and people believe the economy is going to slow down, and so that's a flight to safety and/or trying to play the duration. There's a lot that goes into it, but my understanding or how I think about it is, if I think there's a problem with our budget, if deficit's going to widen and those things, the required yield that you would want relative that's what I think of term premium. If he's come up with some calculation and maybe he's figured something out that he's saying the bond market's already efficient. So term premium is already built into what you're seeing as far as the price.
He's saying the quoted ACM model that the Federal Reserve made, that Moody's quotes, that everyone quotes, that was on the front page of Bloomberg.com, that it doesn't
So what does that mean? So what does he do
measures
with that?
The yield curve. Your definition is not measured by that thing. Like it's different.
Okay.
Yeah.
So he's come up with some different calculation. Now,
yeah.
All right. So that's great to get opinions. Now, what does he do with that? Is he saying that treasuries appear to be safer than people think they are because of what he's saying? Or is he like, how does he use that?
He actually said, so I think for traders, he says bonds are for trading, not for investing. And he thinks that he's not super bullish on bonds. No.
Yeah. Whatever his quant guy, what is this quant says? He's bullish on equities?
So you know how quant guys are, like basically they have an answer, and every single time they say, you ask them why, they say like, because my computer said so.
I have a great story on that, but go ahead.
Okay, well, let's hear the story.
No, I want to hear your story. But totally separate. But go ahead about quant guys.
Yeah. So I try and not have too many quants on my show, but he's one of the best in my view.
So I once had a conversation with a quant who was working at the same firm that I was, and he traded a lot of energy. And we're having a conversation, and I'm trying to learn more about his system and how he operates. And I said to him, I go, oh, so what's your position on oil right now? He goes, short. I go, why? I'm just curious. He goes, well, the quants are showing this short. I go, let me ask you a question. I said, what if I knew for 1,000% fact that Iran had just hit the button and a nuclear warhead was headed in the Middle East? I'm like, I would think that oil would go up to $200 a barrel. Do you? He goes, don't know, but I'm staying short right now no matter what. So I was pointing out the obvious is that the quants obviously tell you the trends that are going on right now, and they can gather a lot of information, and it's probably becoming more sophisticated with AI and tools that are going on. But that's my problem with kind of quant models is the exogenous or crazy one-off events that are going to occur, right, that you can't predict, right, that we've seen time and time again over many years. We've seen things that are happening out of left field. So that's when quant models turn completely the other way. And so give me your thoughts on that. Because
yeah. So one thing that I learned from the general quant community, and I won't name names here, is that like the insane hedge fund returns in macro of 1980s, 1990s, maybe even 1970s, like the founders of those funds now will like basically are podcasters, and they're talking about like extremely huge like Jupiter Savage, like galactic level macro, about everything. But like their recent returns, maybe not so good, but like when they had those 20% year after year after year in the 80s and 90s, all trend following.
Gotcha. All right.
So it's like the macro theorizing that is, quite popular, on my show, definitely. Like it's a lot of the great track records were built on the quant stuff. Now I'll say, I think trend following more recently has not performed nearly as well. So I think it's the time for
the side of the trade, there's a lot of trades which are using the same program.
Yeah, exactly.
Like. So that's why you see these moves, right? And they're levered vehicles also. When things go the other way, you see how the unwind occurs rather quickly.
Yeah. By the way, okay, I discovered this today. This is definitely not a recommendation. In fact, I might take the other side of this. But there's a quantum computing. There's a quantum computing stock, QBTS, D-Wave or something.
Yeah.
There's a double levered long ETF, QBTM or something, that has the twice daily return of QBTS. Okay, the realized volatility of QBTS peaked in like 300. So that means it's going up like 15% a day, but let's even say it's 10% a day. Yeah. That means that this fundamental vehicle goes up 20% and down 20%. 0.8 times 1.2 is 96. So like basically the variance drag is down like 4% a day.
Not only that, they can't even keep up. Those things don't perform in line with how they should if they were efficient.
And if they did perform well, they wouldn't perform.
Right. There's been MicroStrategy, 3x bear, 3x bull. This thing just doesn't. And they use the option market because they can't even get enough stock, even if it's like if the ETF grows by nature, that 3x ETF or whatever it's going to be, it can't work. The math doesn't work at a point. So yes, you point that out. So you've never been a professional trader, right? But you've interviewed a lot of them. You've talked to a lot of them. And what's really interesting to me about your generation of traders is the tools that you guys have at your fingertips now. We didn't have as traders, meaning retail didn't even have at the time. So the democratization of information is great, right? The tools available to trade, 24/7, nobody wants to do that, but whatever, great. What do you use the most? Kind of what do you look at other than obviously talking to your guests and so forth that you have that you like to look at? Is it Bloomberg? Is it Talk to me about what you like to look at for the markets.
I use a service that I can just track like net income, dividends, revenue growth, Sharpe ratio, all type of stuff. So like a cheaper version of Bloomberg. I won't name it because it's I don't want to give any, but I do get it for free. Like that's a benefit. So
you get it for free.
I get it for free. Yeah.
Because of who you are, or because you hacked it.
No, because I know that stuff.
Gotcha. Yeah. Okay.
But they, people definitely would, you 100% would have heard of it. So
I think I know it, but yeah.
Yeah, that's, so yeah, information is free. I honestly feel like there's a lot of stuff that you could do with like 1960s level technology. Okay, admittedly, like,
too much noise. You're saying you sift through the noise.
Yeah, admittedly, like, look, I'm not like going to the office to get the annual report, but I think that it's not, you don't have to be that high tech. Okay, I think there's a lot of stuff with AI that I'm a little bit behind on, like just using AI for stuff. But in my own personal investing, like I like finding stocks that like no one's ever heard of, and then just seeing if I like them.
So do I. But you read 10Qs and 10Ks at all?
Yes.
You go through those.
Yeah.
The problem with AI is you want to go in it to confirm like a question that, like I was looking the other day, which airlines hedge oil, which don't? I just wanted an update on Delta United. Yeah, Delta United don't. Delta owns a refinery. Mm-hmm. Southwest didn't pay for it. Yeah. So those are things that I use it for kind of as an added piece of knowledge. I would never go to it for what are the earnings, what are the, to your point, like, I think you got to be very selective. And I'm sure that, again, your generation, people are able to shape and use this in a way that make much quicker decisions. Now, the computers are always going to be ahead of us. Doesn't matter. They've already built those AI tools, right? Certain words come on the tape. The algos pick it up. Raising, adjusted EBITDA, whatever it might be. I've found that you can take advantage of the algos and computers over time if you do fundamental research and there's a reaction wrong way, lower or higher. And I think we've seen a lot of that in the markets too, like certain stock reactions.
Yeah, I think there is something said for knowing companies, and it's all about your level of relative knowledge. Like, there's some Chinese companies that I understand it pretty well on an absolute basis, but not super well. But relative to everyone else, I understand them super well because no one knows who these companies are.
Was this your tweet about the fintech company
Yeah,
that
yeah.
you wish you hadn't have sold?
Yeah. Trimmed. I wish I hadn't trimmed. Yeah.
But you made a comment that this is really interesting. You focus on the macro because you have to. You've talked about the Fed. We've been sitting here talking about term premium. That's macro stuff, right? And we talked about macroeconomics, micro. You got to, unfortunately, for better or for worse, you got to know what's going on in the macro to get the micro. So, to blame yourself or be upset with yourself for making that decision, you got to be intellectually honest here.
Yeah, okay. I did trim my China holdings based on, I was like, 145% on tariffs on China. This is intense. And also there's some whispers of some delisting risks, which obviously hasn't happened. So I was a little bit silly. And also China was outperforming the US so much, and I've been very long China. So I'm like, I got to take my chips off the table.
Yeah,
but
those all went into it.
Yeah, there's only two sizes.
Don't be a pig.
Too big or too small,
Yeah, bulls, bears, and pigs.
Yeah.
Pigs get slaughtered. You were not a pig. So let me ask you a question. So give me your current thoughts then forget the Fed for a second. Give me your current thoughts on the markets here. I would say bonds and equities both. And I'll add to that while you're thinking about that. Who do you read? I know I told you about tools. Who do you get up and read? Who's the first people that you kind of want to hear their thoughts? I mean, we know the Gromans and the Aikens of the world just in general, but is there one particular or two particular newsletters or people that you like to listen to?
I think Joseph Wang is the man. I think Citrini is the man.
Who's Citrini?
He's a Substack researcher who uses a lot of AI tools, but he has thematic baskets. Okay. Which his model portfolio track record quite good. Okay. He just had a piece out robotics. I haven't read it yet, but I find he's typically early, and also I feel like in the world of macro and also in the world of thematics, which are the thing they have in common is you have to be early. Whereas in micro, I feel like it's a little bit less about being early because you generally hold for longer time periods,
Are you a believer in behavioral finance? Do you recognize when everybody's on one side, you want to be on the other, or do you?
Yeah, I think definitely more than a grain of truth there. And also, it's funny you say that because in the probably was April 9th, there is a AI bull bear scenario. It's like, this is the most bearish reading we've ever had, and I'm like, okay, normally that's a contrarian signals that you want to be bullish, but this time is different.
I think you asked me that on the podcast, and I go, I think this time might be different. No, I said there's other things you can look at too. It is the confirmation bias. It is actually one of the best ones. It may take a week, it may take a day, but the bull bear, all those the put call ratios that are out there. And by the way, put call ratios are self-fulfilling. Yeah. That it's going to work because at some point there's such a pent-up demand that the stock that's going to have to be covered, the amount of puts that are out there if it doesn't happen. So market makers and stuff, and that's a whole nother level. I know you've had guests on that have talked about kind of open interest and the stuff that might mean in the options market, I would assume.
Yeah, and growing up, I definitely was, and I still am obviously a huge fan of Warren Buffett and fundamental analysis. I still that's still my how I view a lot of markets. But I used to totally poo-poo and just think technical analysis was worthless. I mean, admittedly, I think I've done a single-digit number of technical analysis interviews of the probably close to 1,000 interviews I've done. But I think talking to other investors who actually use technical analysis, who I really respect, I'm like, whoa, maybe there's something here, even if it is purely psychology and you only should care about it because other people care about it, still that should help with entry and exit points. And I'll say,
So you're talking about charts themselves. You got
I heard Vinny Daniels talk about, well, the RSI this, the RSI that. I'm like,
the relative strength index. But those things can last for a period of time. But I was going to say and I hope I'm going to get the right answer to this question. I assume you're a fan of short selling because you're a fan of free markets. Okay.
Yes.
And the best longs are the ones that have large short interest, where you think that you have found a change in the business model or something that is occurring, in real time. And that's powerful. So for people out there, they know my feeling on short selling. I think it's part of the system, and I think it should be there.
I completely agree, and I think, I like short selling a lot.
But it's not just short selling. What I'm saying is you can use it the other way. If I'm long something, and there's shorts, I want to talk to the shorts. I want to go find out what their thesis is, and if they bring something new, I'm like, wow, that's really interesting.
Yeah.
If they tell me everything I already know, then I'm going to buy more. And so people need to get off and worry, short sellers are the devil. This and that. No, they're part of the market. And if anything, if you're confident actually, and you're open-minded and not blinded, it can be a huge catalyst. So that's a technical that can quickly turn into a fundamental in terms of.
Absolutely. Here's where I'm going to disagree with you a little bit. Is tell me what's an example. I think the stocks that are the most shorted are the ones that are crap.
The most shorted stocks perform the worst over a long period of time.
So when you said
that? I'm saying there's certain ones. Certain ones are going to go into the abyss. So let me rephrase. I'm just saying sometimes I'll give you an example. Porter and Vinny have been long this Sable Offshore, this SOC. 18% of the float is short.
Yeah.
Things up from 19 to 34 in 3 days. Literally 5 days. They were on the podcast last week talking about it was like 20, 21. Okay, the thing shot up. And it's shot up because they turned on a well. They're producing in Southern California. No one can believe they're letting them drill and actually pull oil, in Southern California. All of a sudden, those shorts are like, we never thought that these guys would even, the oil would flow. My point is that's a powerful long. What I'm saying, most shorts that you find, high short interest, the story has either played out or it's such a tough borrow or the cost to borrow is so high it's not as good. But I will say to your point, the largest short interests of the names are those stocks will be the worst performers over a long period of time. But go ahead with what you were getting at, because
just about Sable Offshore, I have no knowledge, but I've heard through the grapevine, let's put it, that maybe the management team there has had some improprieties in the past in terms of like buying private planes with shareholder money and stuff. So I urge caution.
I don't know about that. I don't know that, and I'm whatever. But the asset came from ExxonMobil, and I don't know all the people involved. All I know is that if oil is flowing, they'll be able to buy as many planes as they probably want. But you were making a comment before. The one thing you don't like about short selling, you were saying there was something you said you disagree with me. Was that because you said?
I disagree. I think some of the best performing high Sharpe ratio stocks, even though Sharpe ratio, it's BS. But like Progressive, Visa, the best performing stocks, right? Highest, they go up every single day, basically. I'm exaggerating.
With no short interest.
Yeah, they have no short interest.
I know.
Yeah.
But I was just saying, if controversial stocks, you were talking about the alpha you find is in the small and mid cap stocks.
Yes,
it's not going to be in the large ones. And so why would you ever? Visa is the best business model ever created in human history. By the way, it's in the XLF, which makes no sense because it's a tech stock. There's nothing to do. There's no financial risk at all with that company, period, end of story. That's a whole nother podcast.
Yeah, but that's why the XLF, you did not want to own it in 2007. You look at it now relative to the holdings that were in 2007 or even 2014, the regional banks that have sucked, basically, that used to be, 2%, 1%, 3% of it, now are 0.1%, 0.2%. And it's I think it's a good thing that Visa's in it.
But my point is that when the XLF quote sells off because people are betting against the banks, that's when you go buy Visa and MasterCard because they get dragged down on the passive versus active investing. That's the stuff that I like to kind of point out, is take advantage of kind of the passive flows. You've grown up in the ETF boom. I mean, passive investing was zero. When I started in this business, was nothing, a couple percentage points. It's now more than half of the market. So it's really changed the way that people kind of manage their money. All right. So let me get to, who have you not interviewed so far that you're trying to get or that you want to get to come on the show? Is there a tough ask? You haven't gotten Druckenmiller yet?
I haven't gotten Druckenmiller. I'd love Druckenmiller. Would love Ray Dalio. Would love Howard Marks. Actually, maybe talking to a few of these teams, trying to figure some things out.
Yeah.
Larry Summers, Janet Yellen, Brian Moynihan of Bank of America, Jane Fraser of Citi.
Tough to get kind of public CEOs is more than, it's just a little bit harder, I would think, unless you go to a conference that they're speaking at and grab them for 15 or 20 minutes, maybe something like that.
Yes.
I would think so. All right. So who's no longer alive that you would want to talk to?
I mean, Volcker.
Yeah. Well, you're fed. You're really a hard fed here thing. So, yeah, keep going.
Yeah.
Like a Jesse Livermore would have been a good guest.
Jesse Livermore
would have been a good guest. Yeah.
Hayek. Daniel Drew, short seller. Bernard Baruch.
Okay. You didn't even know I was going to ask this question.
Charlie Munger.
Okay. You had a chance. I mean, blew it.
Yeah.
Couple months off, but yeah. All right. So one last topic I want to get to. that you and I talked at length on your podcast, and I want to now turn the tables on you and get your thoughts on it, is kind of the role of private equity, really private credit here. And since you are so attuned to what the Fed is doing in the banking system, you're well aware that these assets are not, they're not in the purview because they're not being, tracked as much. Do you see this being a problem? And that's not a rhetorical question. I mean, do you see this being a problem? And if we do go into a recession and credit spreads widen, and those two things would happen obviously simultaneously, what are your thoughts here? What are we dealing with potentially? Because you've had a lot of guests on which are in the space, and your recent guest you just had on, I thought, did a great job explaining that.
Thank you. So a few things. I want to do my own analysis, but when people are clearly better than me and know that, I defer to them. So like in the Chinese fintech example, it's like, none of the banks cover this in America. Like everyone speaks Chinese. Like I can't do that, But so I got to do my own analysis. But on the topic of this, like I defer to other people, but then I also rate them by their bias. So for example, if someone who's always bullish has a note of caution, I pay attention. If someone who's always bearish says something bullish, I pay attention. So when you, Vinny and Porter, who were they're in the Big Short and in the Great Financial Crisis, where all this basically private credit, you're attentive to credit risks is what
Correct.
I'm saying. When you say that you don't think private credit is going to be systemic, all three of you, actually, you and Vinny, although I think probably Porter may feel the same. I don't want to speak for him. Then I'm like, maybe it's not. And I also talked to people.
You're saying that we're saying it is a systemic?
No, that it's not. That's not.
Well, I think the government will bail it out, and so do you, since you think the Fed will have our back. But give me your opinion. But I'm saying I think it's an issue. It's not going to bring down the system. To your point. It's not systemic, but it's going to be an issue, I think. And the banks are first loss in some of this stuff too. They're providing some of the loans and stuff that are out there to get some of these deals done. But yeah.
Here's the okay. I think that these loans have performed really well. And the back test, which needs nothing, in the same way, like in 2007, mortgage loans had always performed well. But I think you'd have to have a huge depression, like you would, where just like there's just mass insolvency. Like even like I know, and this is the talking point of the CLO industry, but like those loans performed very well in terms of the ultimate payout and recovery. Like yes, they went from 100 cents to 40 cents, and Howard Marks bought them all, but like those loans ultimately were good. And so I do think you can escape things with not mark to market if there's no run risk, which I think there's not.
I think the run risk is, and I was talking to Vinny about this yesterday actually. So you go back to subprime in 2000, kind of 6 and 7. What set the stage for the collapse was that banks were providing the wholesale lines for the mortgage companies to go out and originate mortgages, create the product itself, so they could then package it in CDOs and all this stuff and then sell it to the insurance companies and pension funds and all that. That was the game. Mm-hmm. When they started cutting off the credit line is when the game ended, because the mortgage companies like, oh God, we have all these mortgages on our balance sheet. And by the way, we sold the good ones. We kept the bad ones. We marked the bad ones at the good price that we sold them at. Now we're screwed.
Is that called warehouse?
The warehouse line. Yeah, exactly. So banks are providing warehouse lines to private equity. That's what they're doing, right? They're providing basically these lines of credit which allow them to go out and get deals done and all this stuff. So that is a tail, Jack, that is existing and will get. And by the way, don't make it. The banks will pull quickly because they're not going to get in this problem again. We're going through the whole period here of too much regulation on banks, which I agree. There's a lot of it that was overdone, but that's the reactionary mechanism. And they don't want to be in a situation where that stuff unwinds and goes back the other way. So I do think there is a tail. I think credit's mispriced. Doesn't mean it's going to collapse.
Yeah.
And we started this podcast talking about Roger Lowenstein, the rise and fall of long-term capital. Those geniuses at long-term capital, the Nobel Prize winners were walking around in that place coming up with Vega on options and how the Russian ruble and the British pound should trade accordingly. And they were right. What happened? The brokers did business for free. Long-term capital convinced the brokerage community they shouldn't charge them commission because it's an honor to see. That's what was written about long-term capital. So I don't think we're at that stage at all. But listen, this history always repeats itself. It's just in a different product, right? And you're a big student of the market. So.
Well, that's another thing, is that the worst companies pay the biggest fees. So like Berkshire Hathaway, every 5 years they'll do a yen deal or something, but they're not like. Whereas if you're a crappy company, you borrow a lot of money, but a lot of high yield bonds, a lot of leveraged loans. I do really respect the Aries and the Apollos and I think they entrepreneurship of those leaders. It was interesting to note in the Berkshire Hathaway meeting, I heard Ajit Jain, who runs their insurance operation, say that he thinks that the private equity companies that have bought all of the insurance companies to have the insurance float, do the Berkshire model basically. He says that their life insurance products have gotten so uncompetitive. So it's interesting. I think he's referring to Apollo and Athene. I mean, that's what.
Yes.
So I think that basically a lot of these insurance companies are probably running like combined loss ratios of close to 100, where they're not like super profitable on the underwriting or not profitable at all. And yeah, okay. Also, I go through like phases of getting into this, getting into that. I definitely have been dabbling in the insurance. Like I'm very new into it, but I like being new into something because you can learn so much. And yeah, it's interesting. A lot of insurance companies are over earning, like car insurance companies, and then excess and surplus, like E&S surplus lines, are like they're insurance companies that are earning 80% combined ratio, which means they have a 20% like gross underwriting profit. But private credit companies want to buy them, and they're like, we'll use the float. Why do we have to sell? Fly them out, take them out to these fancy restaurants to get them to buy our products.
Right.
Why can't we just own the entire company?
Right.
Yeah.
Make it vertical. Exactly. Well, I'm sure you're going to be talking about that and many more things on your podcast. And like I said, listen, I know I pointed out that you were born in 1996, and take this as a compliment. You look young, stay young, right? Please keep getting these great guests on that you have coming on, and I look forward to watching you build out your network. I know we didn't get a chance to really talk about kind of the newest product, which is Other People's Money, which is getting hedge fund managers and people that manage to come on. I know that's kind of, if you want to talk about that for a second. Here.
Yeah, that's my partner's show, Max Wheathy's show, Other People's Money. So it's really about the business of hedge funds, because there are a lot of macro shows. There are a lot of micro shows about, this company this company that. Here's how, Wrigley Gum got started. And all those are great shows. But Max really wanted to fill a niche of, how do you start a hedge fund? Basically how I built this for hedge funds, because there are a lot of people, they have a hot hand in markets. They're actually a good trader. Maybe not that lucky. They're actually a good investor, but that's basically table stakes. If you're a good investor, and I'm sure you've met many of these people in your life who actually are good investors, but they just kind of suck at the operations of, they don't know how to raise money. They don't know how to manage risk. They don't know how to manage costs. Raising money, they hired some guy who went to Harvard, and they think that that's all you need to raise money. It's he went to Harvard, he knows everybody. Like, maybe that was true 30 years ago, but it's definitely not true now. It's about how do you manage a website? What's your brand? Are you on Twitter? And various other things.
Right.
But yeah, it's just like saying, I design a good shoe, therefore I'll have a successful fashion company. It's just not how it works.
No, you're right. And so really appreciate all the stuff that you do. Find you obviously on X at Jack Farley 96. You can find you on YouTube and on Spotify and Apple, Monetary Matters podcast. And I think you have a network site as well. So congrats on everything that you've been doing, and hope to have you back on here soon.
Thanks, man. It's been an absolute pleasure.